So I'll go ahead and get started. What I'm going to do today is I'll start with a review of the account. We're going to look at this data as of 12/31. I know that the numbers that Jimmy went over actually went through, I think you said close of business yesterday. But so what I'm going to show you today is going to be through 12/31. We'll do a review of the account, and then Porter will step in, and he's going to talk to you about our outlook and, where things are going, where we're seeing things from here. So if y'all want to go ahead and flip to page 5 in your presentation, this is the executive summary. Again, this is that page that I've said that if someone were to miss the meeting today, you could probably just pull this page out and show it to them and give them a summary of kind of what we're going to discuss today. Of course, it's got your Westwood, your investment manager, which is Westwood, and the InStyle, which is our enhanced balance. Your benchmark, this is your target benchmark. This is your custom benchmark for the fund. And you can see each of the components there and the percentages of those. Your peer group, when we look at other people that are invested in the same type of allocation, we look at the eVestment Alliance Tactical Asset Allocation Group. The inception date with Westwood of 1/1/2011, and back in 2011, you gave us just over $9.9 million to invest. Below that, what we have here is the quarterly cash flow information. So this is just for 4Q. I know your agenda has year-to-date, so when you're looking at the differences in those numbers, these are just for the fourth quarter. So you can see your contributions of just over $500,000, your expenses of $4,194.40, your benefit payments of $431,489, and then those distributions, which include drops and rollovers, of $24,973.75. The current market value as of 12/31 was at $14.2 million, just about 14.3. And if you look below that, we've got your since inception investment earnings on the account since you've invested with us, and that's just at almost $3.6 million of investment earnings since you invested with us. We've got your since inception annualized and net return, that 8.5% and 7.7% respectively. The last time I was here, your assumed annual rate was still at that 7.25, but after this meeting, we will adjust that to reflect 7.5 going forward. And as you can see, those since inceptions, annualized and gross and net returns are still above that assumed rate that you have at 7.5%. If you want to go ahead and flip over to page 6, this is the current asset allocation. This shows how the account is allocated as of 12/31. The upper left-hand box is going to show you how we look at things in those 3 buckets, being equity, fixed income, and your specialty. Below that, where you're going to be able to see the breakout of those different buckets. So to the far left and the bottom left, you're going to see your equity bucket. So you can see that equity bucket includes your small cap, your mid cap plus, your large cap, your domestic growth, which is all cap growth managed by William Blair, and your emerging markets and global equity, which are managed by Westwood International Advisors out of Toronto. Your fixed income bucket down the middle shows your international bonds, which is managed by Brandywine. Your investment grade, high yield, short duration, high yield, and cash is in that bucket. And then to the far right is that specialty asset class that we talked about. This will include your REITs, your master limited partnerships, and then our income opportunity strategy. That's that tactical asset allocation strategy that we have. And up in the far right, you can see a chart that just represents those different allocations. Does anybody have any questions about the asset allocation as of 12/31? All right. So if you want to proceed, we can flip over to page 7. This is what we call your account summary. This is a way of looking at your performance in a dollars and cents fashion. The blue bars on this chart on the left-hand side, those are going to represent a market value at a given point in time. That green line that runs across those blue bars represents your investment basis. So if you want to look at that as the cash flow line, this line shows where you originally invested with us on the far left at that $9.9 million, and then shows all of the cash withdrawals and deposits in. And you can see it where we're at, the difference on the far right-hand side between where that green line sits and that blue bar is, that's the investment earnings on the account, and that's that $3.57 million on the account since inception. So you can see on the right-hand side, those are the cash flows, those yearly cash flows. So you can see where those move that green line up and down, and you've got a total of $784,970 of, contributions, of net contributions into the account. So does anybody have any questions on that? All right. What we have on page 8, this is a page that we put together just for you. What we've done is we've shown you on the far right-hand side where we have our target allocation for enhanced balance. For other plans that are invested like yourself, this is where we actually have things lined up. The left-hand column that says actual allocation, that's where the account is sitting at as of 12/31. So if you look down these columns, you can see that you're just about right on target, give or take, depending on some fluctuations in the market, but just about right on target. One thing I did want to mention on this is that if you look at the income opportunity strategy, which is going to be included in that capital appreciation bucket, what we've done is we've actually split out income opportunity for the purposes of this 50-50 into the capital appreciation and income. I do want to point out that when we look at it where it stands right now, the actual allocation of income opportunity is more of a 70-30 split, 70% in the equity range, 30% into the fixed income. If y'all would like to see it in a 70-30 split like that, we can do it. Or if we want to leave it at the 50-50, we can keep it like that as well. And that's just certainly something you can let me know at any time. We can make a change. And then, if no questions there, we can jump over to page 9 and talk about the performance of the account. What we've done here is on the top 2 lines are going to show your total fund performance. We've got calendar year, we've got trailing, and then we've got since inception to the far right, and these numbers are as of 12/31. We've shown you both gross and net returns. And then you can see the line underneath net that's going to say your target benchmark. So if you look at 2014, we ended the year at 6%. Then you can see that 1-year trailing, which is that same number as of 12/31 of 6%. And then that strong number as 3-year, 11.5%. And then the since inception at 8.5. All of those which meet and exceed your assumed annual return rate. One thing I did this time, which is different, is we also showed you the benchmark that we typically use for other plans that are allocated in this fashion. I know the last time we were here, we talked about your benchmark, and it was decided when you were actually looking for new managers, pre the RFP. So we just wanted to show you the benchmark that other funds that are allocated just like yourselves are invested in as well on that bottom line. Does anybody have any questions? If not, I'll turn it over to Porter.
Perfect. Well, staying on this page, let me cover a few things because I think it's the target. One of the things at Westwood, and we believe long-term, that having assets out of the U.S. dollar is beneficial. So when I look at the main difference between the target benchmark and this global 60/40 benchmark is just that. So your target benchmark only has 7.5% allocated to international fixed income, or excuse me, just international equities. And so that was absolutely the worst place to be, and it has been perhaps the wrong place to be for the last couple of years. So any benchmark that includes more international is worse off. So your target benchmark, when you look at that, is very heavily U.S. large cap dominated. Well, that was the absolute best place to be last year. And so that's why you'll see quite a disparity there. If you have a large international run, which we do think would happen, it'll happen over the course of the plan at some point, you'll see that y'all's target benchmark lag. And so one of the things we did want to talk about was, is the target benchmark relative? It was kind of arbitrarily picked out. It is not at all how we manage money. We don't care showing it, but it's just there.
The target benchmark numbers that you have in here also, and the global, are those gross or net? Because
benchmarks are gross.
That's
just
gross.
Because there's no.
Because they haven't taken their fees out yet. But see, that's something relative for us to look at when we're comparing our performance against the target and the others global split, isn't it?
Well, not really if you think about it, because if you're really going pure, if all you're buying is ETFs and stuff like that, you're going to have your money with Charles Schwab or somebody like that that doesn't do anything for you, and then you don't have hardly any fees.
So
This is
you
probably
judge,
not far off, yeah.
You judge your fund net of fees with what they're showing.
Yeah, you're paying
as
for
gross.
right. Advice.
But yeah, there is a fee for owning ETFs, domestic ETFs and fixed income ETFs, stuff that is very liquid U.S. based. Those fees aren't very high at all. if you step outside of the US, you know, an IFA iShare, I'm guessing here off the top of my head, might have a 60 basis point fee on it. So if you stay purely domestic and purely, you know, kind of plain vanilla, you know, I've seen, you know, less than 10 basis points on fees. You know, but
But the way you've got this calculated, it's already got that fee netted out of it. So when you use the Russell 1000 and you put the results in there, you've already got the fee netted out, don't you?
we actually use the actual benchmark, not the ETF for the return. So the Russell 1000 is a benchmark, and then there's ETF providers that.
Oh, like Vanguard, you would take out the difference.
So if we would have run it versus the Vanguard Russell 1000 ETF, that would be net of its fees.
Oh, I see.
The Russell 1000 is actually a benchmark produced by Russell that has no fees in it whatsoever.
Okay,
So that's
right.
you're right. If we
So
picked
this
the
is really
ETF,
what
then it
this
would be
is.
truly net of
And
fees.
we're paying.
But in this instance, we actually use the actual benchmark data. So, I mean, that's you know, what's happened over the last few years, where do you want to be? You want to be US-based and you want to be passive. You know, that was, you know, we firmly believe over long periods of time, and our performance shows this, that, you know, active works and, you know, being allocated to assets out of the US is long-term beneficial. But I just point that out on, you know, showing your benchmark. The other thing we talked about, or y'all just made a motion on, you know, we spend a lot of time doing forecasts on assumed rates and what we think a balanced portfolio like this should return. You know, with traditional fixed income, and we'll get to my outlook here in a second, I promise, but I did want to make a acknowledgement here. We do see lower than historic returns going forward. You know, definitely over the next 5 years. And your crystal ball gets pretty murky when you look out much further than that. But I would say historically, if you would expect a balanced manager to get somewhere between 8 and 10, I think we're looking at between 6 and 8. You know, so I think there is an adjustment to, you know, historical type returns. I know the actuary looks back and says, historically, this is how a manager's done, and so therefore, you know, we maybe perhaps could extrapolate out that they could do that again. I would say, you know, if you just very simplistically look at fixed income, which traditionally would make up 40% of your return, well, that's been returning, you know, 6 to 8% a year for you without much effort. Well, as we go into a rising rate environment, your fixed income return, so 40% of your portfolio could actually have a negative return. And that's where you get our advice, and we allocate to different asset classes and work around that. But you've got, you know, a bulk of your fund invested in a spot where you're going to get lower than traditional historic returns. And so we're just out cautioning people, you know, saying, you know, especially if you're up in the 8%, 8.25% type assumed rates, that's going to be very, very tough sledding for the next, you know, 5 years. I think you're down in the range where, you know, I think it's doable, but it's not, you know, the slam dunk. You know, just think back to 2006, 2007 when cash was paying you 5%. Okay, well, your risk-free rate of return was 5%. So getting an additional 3% above the risk-free rate was, you know, that's a manageable thing to do. Now cash pays you, you know, 0.005, not even, you know, nothing. And so now you've got, historically, where you only had to get 300 or so above the risk-free rate, now you've got to get 7.5% above the risk-free rate to hit your assumed rate. So we just caution that, you know, going forward, you know, definitely until we return to a more normalized environment, and I can't tell you when that will be, I'll just tell you it's not normal, the environment we're in right now, that, you know, assumed rates are going to be harder to get, you know, we would, you know, for at least the next 5 years.
What do you think that assumed rate should be?
You know, I think, you know, I think if you had to peg me down, I would say over the next 5 years, a balanced portfolio like this is somewhere between 6 and 8% gross, you know. And so you've got roughly 70 basis points in fees. That knocks you to best case, you know, 7.25, 7.5, you know, on the top end, you know. So I think you're there, you know. I don't think you're so far out of stretch.
You're saying the 7.25 would have been more conservative approach?
You know, there's a lot that goes into the actuarial reports, you know, that investment returns, as much as we would like to take credit for, you know, making those, actuarial reports look good, you know, that's just one of the inputs. And I think the actuary has a better sense of, you know, how that all looks. You know, I would just say on the pure investment side, when we look at it, I think 7.5 is doable, but I think that's, you know, towards the upper end of what we see over the next 5 years. But if you're taking an actuarial report and rolling it out on a 30-year time horizon, absolutely, that's doable. I'm just saying what we see over the next few years is you know, that's a significant hurdle.
Are you seeing some of the funds that you're working with modifying their thoughts right now?
I see them, and I see the actuaries pushing hard to get them sub-8. You know, where they're up, you know, 8.25, 8. You know, that seems not reasonable.
No, I'm talking about, are you seeing them modify their direction on, hey, we want less fixed income and more something else? Are you seeing people change their mixes, or are you seeing them just adjusting their expectations?
Both. You know, and I think we do an analysis, you know, if someone's got between, let's say, a 7.25 and an 8% assumed rate, it's very hard to customize in that range because that's a pretty tight, you know, allocation. So I mean, when we look at our clients, we look first at what's their assumed rate and how do we need to manage to our best expectations to get there. So if you look at our traditional fixed income, if you were to go back to page 6, historically, you know, you would suspect or expect somewhere 30+% in investment grade fixed income. If you look down that middle column there, investment grade fixed income is at 20. So we're already, you know, underweight U.S. investment grade fixed income. And where we go with that is we find other areas in the fixed income market to try to go out and find an increased return. So international fixed income is an area where, you know, there's other countries that have, you know, better debt to GDP ratios in areas where, their government bonds are paying a higher rate. You know, you've got some currency exposure, and so we've got some FX currency hedging and some stuff that we have to do there to mitigate that. But on a pure return basis, you know, you can get some higher coupon fixed income investments. And then you go down in credit quality. You know, if investment grade isn't going to pay you, then you drop down in credit quality and try to find some non-investment grade investments that can return.
What do you think about our current weight in equity, fixed income, 51% in equity?
So the asset allocation committee, just as a reminder of how we come to these asset allocations, it's kind of a three-leg stool or a three-part process. We do capital markets outlook, and I'll talk to you about our capital markets, and there's a page in there about what we're looking for there. We also have an internal asset allocation committee that's made up of senior management, and then we use our outside consultant, NEPC, which is the largest independent investment consulting firm in the U.S. And so we utilized those three inputs to derive where we think a plan that has a 7.5% assumed rate, what's the best asset allocation we can come up with. We are actively finalizing a change to the asset allocation, so you'll see a slight shift in asset allocation, but it's not, you know, it's a percent here or a percent there. So we feel like we're in the right, you know, we're correctly allocated. There's some things that, you know, some duration risk on the fixed income side that we want to address, and there's some emerging markets and global issues that we want to work on as well. So one of the things, global equities, which is one of your portfolios, didn't perform very well last year. And so one of the things we're looking at there is to get a pure European mandate in there as well to take some exposure there. So there are changes being recommended in the asset allocation. They're not, we haven't finalized them. I sit on the committee, so I'm familiar with what we're trying to accomplish. But it's just that, how do we get our clients, in a lower return environment going forward over the next 5 years? How do we give them a fighting chance to meet their expectations? And so that's what we're working on diligently to make a change. And I would suspect we're weeks away from rolling out that change. It won't be that long.
Who's the outside consultant you mentioned?
It's NEPC. They're out of Boston. Their prior name was New England Pension Consultants. And they work with the biggest of the bigs, $1 billion plus pension plans. And so one of the things, if this was prior to you all being involved, but if you think back to 2008, one of the things that we discovered was when we thought we were diversified, and this happened to everybody, not just Westwood, when we thought we were diversified, 2008 hit, and lo and behold, everything moved in conjunction with each other, and there was really no safe place to hide. One of the things we found is that this is pre-NEPC, but that we fell in love with our managers, or we gave them more rope than they should. And so a good example is Global Equity, where, we really like the guy that's managing it, but NEPC is, they come in and challenge us, because if you have the personal relationship with that guy, you tend to maybe give them a little more rope than they should. So they frankly came in at the last meeting and said, we've got to do something else here. And I think historically, we probably would have given them a few more quarters leeway, and this is why we hired them, is to come in and help us make those tough decisions. Because if you're talking to this manager and you become friends and you see him, and sometimes that's a very hard decision, but ultimately it's a business decision. So we brought them in to really kind of be that axe for us to say, hey, they're really great people and we like how they're managing money, but you really got to think about their opportunity set versus another opportunity set, and we like this opportunity set better. And so doesn't mean you have to get rid of them, but maybe we don't leave all the money with them. We take some of the money away from them and move it. And I think what we found pre-2008 was we were slow to react. And so we have them come in, and there's the last layer of oversight is we have an independent board at Westwood Trust, the investment committee, which is made up of outside board members. They're not Westwood employees. And we have Bob McTeer, who used to be the Dallas Fed chairman, Jeffrey Norman, who is a big GE asset management guy, Carol Proffer, who used to run one of the largest consulting firms in the investment arena. We have very strong investment personnel that sit on this committee and challenge us to say, hey, we understand what you're doing, but have you thought about it this way? And so NEPC comes in and gives them the independent oversight so that there's no bias from Westwood. And it's a very well thought out process, and it works very, very well. It sounds kind of convoluted, I guess, probably hearing it from, as I speak, but, we take it very serious. And so the asset allocation is something we spend a lot of time on. Manager selection is something we spend a lot of time on. But it is designed with, pension plans in mind. How are we going to help them hit this assumed rate of return? And so that's this allocation.
So basically, you're saying for the next 3 years or so, the returns after fees might be from, let's say, the mid to high fives to the low sevens. But now, we're thinking 15 years out. I mean, you're not saying we ought to change our assumed return for 3 years, are you?
No, and if you were sitting at 8.25, I'd be saying, yes, I think we've got a problem. Because I don't think over 15 years that's a doable number. What we have to have in the investment markets is, there's no better way to say it than just a return to normal. Think back to the great old days where at least you got 3% in cash or something. I mean, we're sitting in this, the Fed is doing everything in their power to get inflation put into the economy. And it's frankly not, it's working to some extent, but today, and I've been in the car, but the Fed released their minutes, and I just saw the headline, which is they're going to keep rates low for an extended period of time. We thought it would be mid to late 2015. You know, it looks like that's gotten pushed out a little bit. They're trying to pump as much liquidity and as much money into this economy to artificially increase inflation. Because inflation is something that we can deal with. No matter at what level, what we can't deal with is deflation. Deflation is one of the most harmful things to the economy. I mean, look at Japan, where they've just been stagnant for 20-plus years. We've done a very, very good job of that, and we're so far ahead of the rest of the world, and everybody else is trying to catch up. But, you know, that's what we're dealing with. And so when you get basically 10-year Treasury returning 1.8%, you know, that makes it very difficult for the rest of the portfolio to pull its weight. What's happened and how we've been able to do that is equity markets have been on a tear for the last 5 years. I mean, just straight up markets on the equity side, and that's, you know, helped pull the rest of the portfolio up. And it's been great, and asset prices have risen, people's homes have gone up in value. But we do think that fixed income is a very difficult place to make money going forward. So any money you have in traditional fixed income at best is, you know, kind of just expensive insurance for the portfolio. And so that's something we know and we're watching and we're monitoring, and we're very, very short duration, because what happens basically, if you think about a bond fund, as they rise interest rates, the value of the bond goes down. So therefore, you know, you can have a negative return in a fixed income investment. The way you counteract that is have very, very short duration, meaning you're only buying bonds that are out 18, 24 months, so that you can hold those bonds and they'll eventually mature at par, and then you can reinvest at a higher rate. But there's no money to be made in doing that. You're just kind of, you know, treading water at best. And so that's the environment that we're operating in, which is we're not taking any big gambles on the fixed income side to try to make an additional 20 basis point type return. We're sitting there just biding our time, basically. We own it because we think it's important to own in your portfolio. We don't want to not own it, because if we do have a major correction, that's the only safety that you have in your portfolios. But we're not looking for that to drive portfolio returns. And so that's why we see, until we can get back to a normalized environment where we get a 10-year Treasury at plus, you know, 4%, cash paying you at least 3%, you know, it's a tough environment to operate in. And that's why you have us, is to, you know, help, you know, to navigate this environment. But we are just out cautioning and saying, hey, let's, you know, this historical 9% type return environment for a balanced fund is not out there. We don't see that for the next few years. When you've got a pension plan that goes out into perpetuity, I don't mind 7.5. I think that's doable over a very long period of time. I would just say over the next few years, that's going to be tough sledding for us, or for any manager, you know. So
We currently have a target range allocation for you on the equity versus fixed of 50 to 70% in equity and 30 to 50% in the fixed, with 0 to 10% being in cash. Or would you recommend that maybe our investment committee or board look at that and adding to or giving you more leadway for y'all's discretion? Or
you know, I don't think so. I think that that's a fair long-term allocation. I think, you know, when, especially in these environments where you get this, hey, we're heading into lower return environment, I think where you start to get in trouble is where you start to chase that return, where you say, hey, the reason you set this is for long-term asset allocation is because it's a prudent asset allocation. And you're going to have really, really good years, and you're going to have years that aren't so good. But trying to chase returns is, I think, ultimately where you get into trouble, where, you know, this is where, you know, you get in a bond fund that's done really good over the last few years because they've taken duration out really far and it's worked out well for them. Well, the flip side is going to be they're going to be the ones that get caught, you know, on the duration side. So I think that it's a reasonable expectation. If we ever get into an area where I say, hey, this is limiting us from our decision-making process, or where we think, hey, we need a little bit more flexibility, we'll be very vocal in coming out and saying, hey, you know, we can operate under this scenario, but we think we're leaving some opportunities on the table by being limited this way. So I don't see anything that's limiting here Ultimately, we take the charge very seriously, but this isn't a long-lived asset or a long-lived plan. And so we want to make sure that we stay, put it in golf terms, within the fairway. We don't want to go out chasing returns because that's a very dangerous game to play.
Thank you.
So I touched some of our outlook. If we go to page 12 and 13, 13 and 14, I'll give you our brief overview, and just for time's sake, let's just go look at 14. When we look at the environment that we're in, we like to put these kind of cutesy names on it, but, a global trapeze act is the operative scenario. If you think about the circus and the trapeze artist, it works really beautifully if everybody does their job right. But if the guy forgets to catch the guy that's flying through the air, that's probably a pretty bad outcome. And so what we're trying to say here is there's lots of moving pieces going to this. And if it works, it'll be beautiful and it'll look great, and we'll kind of come through this kind of unscathed through the year. But if it doesn't work, we've got some problems. And the one that scares us the most is scenario 3, which is the race to zero, which is basically where deflation comes into play. And as I said, that's pretty much the hardest thing for fiscal policy to deal with. And basically a race to zero means, everybody's cutting rates as fast as possible. If you look at, in Europe and some of the countries over there, they're paying, an investor is paying to park their money in their bonds. So, where here we might make just 0.2% for buying a bond, there you can pay up to 2% just for them to hold your money. Think about that. You give them $100, they're going to give you $98 back in a few years. That's the environment that they're operating in. And that's, just think about that for a while. You're better off, doing something else with the money almost. But why do people do that? They're worried about deflation. And so what you have is everybody's racing to the U.S. and putting their assets again in the U.S. And that's what's holding our rates down. We are, the best house on a very bad block at this point. And so, but that ultimately is not a bad thing. We think the U.S. is positioned to do well. We think GDP in the operative scenario is just under 3%, so not great growth, but not anemic. Take a look at the very bottom line on the left-hand side where it says equal weight equities. That'll give you a sense, go one line up, actually, equities, because the S&P is cap weighted, so certain stocks have a different influence on the return. For at the end of December, we saw about an 8% rise in the S&P 500 for the year. Scenario 2, which is all in, which is our, if you think back to like poker where you just make all your bets and you just hope for the best. That's a good environment for equities. Not so good. Right above that is fixed income. What you basically have is inflation starts to creep up a little bit. But what you mainly have, there's two things that control the stock price. It's the profitability of the company and how much you're willing to pay for the profits. And in that scenario, you just have people willing to pay more. And that's called the PE ratio. When you hear that, basically it's the amount you're willing to pay. So you have a PE expansion there. People willing to pay, they're chasing returns. And so you see, and the other, the scenario 3, which is that race to zero deflationary environment, you can see that's why we hold fixed income in the portfolio, because you have a negative equity return, but you can see you do get a positive fixed income return. So that's the balancing act that we're walking or trying to fly around on the trapeze. We're dealing with an environment that I think is more difficult than some of the environments we've been in. I don't want you to take that as an extreme negative, because we're actually very positive on the U.S. economy. I think things are going really well here. The drop in oil prices, while not great for Texas, is a pretty big boom. When I filled up my car on the way down here, it was less than $50. That's more money I have to spend on bubble gum or whatever else I want in the convenience store. So, consumers are spending some money. We're seeing them pay down debt. We're seeing them buy goods. But all in all, we're pretty pro-US right now. We'll continue to have an overweight to the US. The dollar's been extremely strong, so we'll continue to watch that. We do think that'll correct itself out here in a bit, but, you know, all in all, don't take away, and I've said a few things that sound probably pretty negative. They're more cautious, but all in all, we're pretty optimistic. And I think we see a good positive return, just not historic averages type return, but all in all, not bad. So, you know, slight changes to the asset allocation. What we'll do when we make those changes, we'll send a letter, the board will get it, but it'll be within your guidelines, and so it's beholden on us to find some non-traditional, and don't think hedge funds, but non-traditional type ways to get some income in this portfolio to help offset the lower fixed income returns. And that's mainly where we're spending our time. We think equities are going to be okay, but there are other items along the capital spectrum of a company, preferreds, converts, things that give us some chance for some income that we'll start to utilize. But all in all, you know, things are well. We're very happy with the performance last year, and we look probably for a pretty similar return this year. So I jumped all around. I hit a few of the highlights, but I'll open it. Any other questions or anything else you want me to cover, I'm more than happy to cover. Well, I would say we truly appreciate the business. This is, we take serious the charge to manage your money. And I assure you that, you know, at Westwood, this is the only thing we're focused on is managing our clients' funds and, you know, helping reach your goals. So thank you very much for that opportunity.
Thank you very much, Mr. Burton. You're welcome to stay if you want to for the rest, or if y'all got other places to be, we understand. Is there any other questions from the board?